First of all, thank you for joining us for the fixed income market commentary for the month of July, Ilene.
Thank you.
For the first question, we've seen a slew of disappointing economic data coming from the US and China, as well as renewed concerns of Eurozone sovereign debt crisis over the month. How do you see these developments could affect the credit and bond market?
A slowdown in the US, China or Europe will affect Malaysia's international trade and dampen its economic growth. But economic activities continue to be supported by domestic demand and consumption, moderating inflation trends, and an accommodative monetary policy. The bond market will continue to attract investors who seek yield pickup in an environment of uncertain global economic recovery. Foreign investors will find the positive interest rate differential of emerging markets over that of developed markets attractive. As demand pushes government bond yields lower, corporate bond spreads in the domestic markets will widen and become increasingly attractive to investors. However, if risk aversion intensifies and foreign investors shift to a risk-off mode, this could see outflows from emerging markets in general. In the case of Malaysia, the impact of fund outflows will be mitigated somewhat by ample liquidity in the system.
Question 2. Australia, China, and India have cut rates in response to a slowing economy. Is Malaysian Central Bank going to follow suit? What do you think our monetary policy stance is going to be?
In the most recent Monetary Policy Committee meet on 5th July, Bank Negara has opted to maintain the overnight policy rate stable at 3%. This rate has been held steady since 5th May 2011, despite uncertainties in the global economy, as the Malaysian economy is supported by domestic demand and aided by moderating inflation on the back of easing global commodity prices. Bank Negara will continue to weigh global developments and their impact on the domestic economic growth as well as inflation outlook. Our view is that Bank Negara is likely to hold the OBR at 3% for the rest of the year, barring any significant upside risk to inflation and downside risk to the uncertain global economic recovery and shocks from the Eurozone debt crisis.
For question 3, recent news that international rating agencies such as S&P and Moody's warned of Malaysia risks of potential credit downgrades. Can you comment on this and impact on our credit market?
Yes, for both rating agencies, one of the key determinants of Malaysia's sovereign rating is how prudently it manages its fiscal deficit. The government is clearly cognizant of the threat of a downgrade and has taken some steps to control the fiscal deficit, such as reducing subsidies. The government has reiterated that they are on track to achieve the 4.7% budget deficit target for 2012 and will see the figure falling to 3% by 2015. Any downgrade would dent investor appetite for Malaysian government bonds, particularly among foreign investors. The high foreign ownership of ringgit-denominated government bonds exposes the local bond market to some degree of vulnerability upon a reversal in foreign fund flows. However, Malaysia's healthy foreign reserves, ample liquidity, and demand from institutional investors should buffer against shocks from foreign fund outflows.
Question 4. Given your view on the outlook, how would you position your funds?
Given the still attractive corporate bond spreads over government bonds, we would seek yield pickup via credits. We expect some volatility in the market, and this will provide trading opportunities for us. Duration-wise, we prefer medium to long-term bonds for yield pickup and shorter-dated ones for liquidity.
I see. Last question for this market commentary. In this turbulent investing climate, what is your advice to our investors?
When choosing funds to invest in, do not focus only on target returns, but pay attention to the compatibility of the choice of your funds with your risk appetite, liquidity needs, and investment horizon. Diversify your investments and try dollar cost averaging in volatile times. Let the professionals manage your funds for you.
I see. Well, thank you so much, Eileen, for sharing your insights in this market commentary.